Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 116 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can help you in your long-term financial journey. Today, what we are going to talk about is something that is so interconnected to your life and you don't even realize it, and that is the Federal Reserve Bank, or otherwise known as the Fed. And so I want to talk to you about the things that the Fed does, what the Fed is, because most of the time the Fed is doing things that, like I said, you don't even see. The common individual is not seeing the actions of the Federal Reserve and how it impacts their lives. So you need a little bit of education on that. You need a little help in understanding what the Fed is, what they do, and how it impacts you. And I hope to help you with all of that in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to get back to any questions or comments that you may leave down there. If you're listening on Apple or Spotify podcast, then just be sure to subscribe and leave me a review on either one of those platforms. That would be greatly appreciated. And then follow me on social media at MNO with Dylan, and everything that I put on social media daily is good supplementary material to the things that I am putting out on the long form episodes every single day. And it'll really help to motivate you and keep you going in the meantime when you're not listening to these episodes. And then if you need somebody to help you walk through your financial life, you need somebody to help you create a financial plan that is specific for you and your family and to help you walk through that place and to stay accountable to that plan, I can help you to do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So the Federal Reserve, or the Fed, as I'm going to go about calling it for the rest of this episode, the Fed was established back in 1913 via the Federal Reserve Act. And this established the Federal Reserve System. And this is an independent governmental entity that would serve as the central bank to the United States government. In addition to the Board of Governors, so there is a Board of Governors, they call it, and we'll dive into that a little bit more here in a little while. There is a Board of Governors, the Board of Directors of the Federal Reserve System, and a Federal Open Market Committee, the FOMC as they call it. We'll dig into that a little more as well. And the act formed 12 Federal Reserve banks spread out across the country. And together, the bank's mission is to provide the nation with stable monetary policy and safe and flexible financial systems. But what does this Federal Reserve Bank really do? What actions do they take, and how do those actions impact you? I hope to answer that today. Even though I gave you the book answer as to what the Federal Reserve System is and what the Federal Reserve is, we want to talk a little bit more about what they really do. So as I said, there are 12 Federal Reserve banks around the nation, and they are split into regions. And their whole job is to protect the regional economic interests, to oversee the member banks of that region, so oversee the banks that you and I bank at in those regions, and ensure that the public has clout in central bank decisions. And although the Federal Reserve banks do not operate for profit, they generate income from interest on government securities, so things like treasury bonds, treasury bills, and the like. And these are the 12 different Federal Reserve banks that there are. There's one in San Francisco, there's one in Dallas, Texas, there's one in Kansas City, Missouri, there's one in Minneapolis, Minnesota, one in Chicago, Illinois, one in St. Louis, Missouri, one in Atlanta, Georgia, one in Richmond, Virginia, one in Philadelphia, Pennsylvania, one in New York, one in Boston, Massachusetts, and one in Cleveland, Ohio. So those are the 12 regional Federal Reserve banks around the country. And one thing that those regional banks do is that they enforce the monetary policies that are set by the Board of Directors of the Federal Reserve System. And they assist the Federal Open Market Committee, the FOMC, and the Federal Reserve as a whole by contributing to the formulation of monetary policy with the data that they provide to the Fed. Each of the regional banks has a large number of researchers and analysts that work there trying to compile data and to come to certain conclusions about the economic data that they bring in to help make decisions throughout the country, not just in their particular region. Now, apart from these regional banks that have some impact on the banking of you and I, depending on which region we are in. One of the most common things that we see, at least on TV, and the people that we see about the Federal Reserve is the Federal Open Market Committee. And we may not even know that that's what it's called, but the Federal Open Market Committee has a lot of impact on our lives. So this is a group of individuals that consists of 12 members, 7 members of the Board of Governors of the Federal Reserve System, the president of the Federal Reserve Bank of New York, because that is the biggest and most consequential of the Federal Reserve regional banks, and 4 of the remaining 11 Federal Reserve Bank presidents who serve one-year terms on a rotating basis, and rotating seats are filled from the following 4 groups of banks. 1 bank president from each group: Boston, Philadelphia, and Richmond, Cleveland and Chicago, Atlanta, St. Louis, and Dallas, Minneapolis, Kansas City, and San Francisco. And then non-voting Reserve Bank presidents attend the meetings of the committee, participate in the discussions, and contribute to the committee's assessment of economic and policy options. So you see that this is a very powerful group of individuals who make a lot of big decisions for our country and for our financial system. And they are led by the chair of the Federal Reserve, who is appointed by the president, and it is currently Jerome Powell. And so you've likely seen, if you pay any attention to financial news or just the news in general, you've likely seen Jerome Powell on television, whether or not you knew that that was him. But Jerome Powell is the face behind the group. He is the face of the Federal Open Market Committee and the Board of Governors. He is the face of this group and is the head that is speaking in front of everyone and is telling everyone the decisions that the group has made. This group, the FOMC, they have really 2 things that they are attempting to do over time. And what they are trying to do is to maximize employment, and they are trying to manage inflation. And they're trying to do so through hopefully stable interest rates to not create a bunch of uncertainty in our financial system. And they have a lot of power over how much inflation there is. They have a lot of power over how much growth there is in the economy. They have a lot of power over how the stock market moves. And I will tell you why that is. Because the Federal Open Market Committee, they can make decisions about what the target rate is, about what the Fed funds rate is, if you've never heard of the Fed funds rate. Well, what this Fed funds rate is the rate at which banks can lend to one another. And if the Fed funds rate is really low, that is like the base rate for all other rates that are set throughout our economy. If you wonder why it is so cheap as far as interest rates to get a mortgage right now, why mortgage rates are so low, we'll go take a look at the Fed funds rate. The Fed funds rate is almost 0. And obviously that is in response to the coronavirus pandemic, and we'll jump into that here shortly. But these decisions that the FOMC makes are impacting us in very, very real ways. And then obviously, if this rate is going to impact how individuals borrow, well, it will also impact how companies borrow. So if the Fed funds rate is lower, it is likely that companies can borrow money for cheaper, for lower interest rates. And if they're able to do so, then that should spur economic growth. That should spur growth in a higher way. And that is why we see the federal funds rate as low as it is right now, because obviously they are trying to spur economic growth, because we're coming out of this recessionary era created by the coronavirus pandemic. And then one of the big things that the Fed does is they try to keep inflation from wrecking the economy. They try to keep inflation from running rampant. And they want some inflation. They want a target amount of inflation, but they do not want overwhelming amounts like we saw in the 70s and 80s. And I've talked about that very briefly when I was talking about the book Stocks for the Long Run, how there was a period of time there where the average inflation rate was like 7% annually. And that really puts a drain on people's ability to be effective within the economy. And the way that they do this, the way that they impact inflation is obviously with the interest rates. They can set interest rates to impact inflation. And if the economy is growing too fast or inflation appears to be growing, then what the Fed can do is they can raise interest rates. And when they raise these interest rates, it makes it more expensive for companies to borrow. It makes it more expensive for individuals to borrow. And obviously, if it's more expensive to borrow, then growth will slow because there's a lower likelihood that more and more individuals will be able to service their debt. And there will be a lower likelihood that more and more companies will be able to service debt at higher interest rates. And so that is how they would do that. And then those higher interest rates, what they do is they slow business growth. They slow consumer spending, right? So people are going to buy less cars. People are going to buy less houses. Companies are going to not issue debt as often as they were. They are not likely to refinance their debt as much as they would otherwise. They're not as likely to pay off any bonds outstanding earlier, things like that. So if the economy is slowing down too much, in contrast to that, what the Fed can do is lower interest rates. And that's what we have seen them do. I've seen them do it twice in my life on a large scale. Obviously, the financial crisis, they did it. And then they have done it again here in the 2020-2021 coronavirus pandemic. And what this does, obviously, is it encourages individuals to borrow. It encourages companies to borrow, and it makes it cheaper to do so, to spur on economic growth, like I said earlier. And so what do you think happens? What do you think happens when the Fed changes their interest rate levels? What do you think happens when they change their outlook? Well, every single time that Jerome Powell comes up and has a press conference or he is going to make a statement, CNBC immediately turns to Jerome Powell and is listening to Jerome Powell. The financial world is listening to Jerome Powell. And the reason that is because the stock market is all about the future. The stock market is all about forecasting what future cash flows will be, what future earnings will be, what future revenues will be. And you know that if rates are increasing, it is going to be harder to grow as fast. And if rates are decreasing, then companies can grow faster. And so what you will typically see is if there are any major shifts in the positive direction of interest rates, then that'll have a negative impact on the stock market as a whole. And then the opposite is true when you see large decreases in the interest rates. Then the stock market, typically that is due to some type of crisis, some type of big issue. If you're dropping interest rates really hard, which they did this past year, and you saw a stabilization, at least for some time, in the stock market. Because if nothing is done and there is a crisis and there is no governing body that is trying to spur economic growth, there is no governing body that is trying to help pick up the country and the companies and the individuals within the economy, then we are much more likely to sit and wallow in the things that we are doing for a long period of time. And so that's what the Fed tries to keep from happening. They try to keep growth occurring. And they do so sometimes very effectively and sometimes to no avail, because growth is not 100% up to them. They can make certain decisions, but they can only do so much. And especially if interest rates are relatively low already, which they already were prior to the coronavirus pandemic, the amount of impact that they have is not as big as it would be if the interest rates would have been 2-3 percentage points higher, and they dropped all the way to zero from there. Now, the Fed does a few other things also other than interest rates, but that is the big one. Obviously, they will offer forward guidance on interest rates and on inflation and on what they expect. And that really helps the markets to make a lot of good logical conclusions as to what will occur later on. We've also seen the Fed, especially this past year and during the Great Recession, do something called quantitative easing, and that being purchasing securities from the market. And when I say securities, typically I'm talking about debt. They are going to purchase the treasury bonds from the market. They're going to purchase treasury bills from the market. And they haven't always limited themselves to treasury bonds and treasury bills. They've also, especially in the Great Recession and thereafter, purchasing mortgage-backed securities that governmental entities were owning. And so they would buy a lot of those as well. And what this does, if they are to do these open market purchases and this quantitative easing, as they called it, that is taking these particular securities out of the financial system. But what are you replacing it with? You are replacing it with cash. And so when things are really bad, what the market needs, what the market wants, what the economy needs and wants is cash in the system. And if they can put cash into the system, they can do so by buying back these securities from the market, and that will put cash into the system that can be circulated and not allow there to be a large liquidity crisis, which can be a big deal for banks and individuals and companies alike. And the Federal Reserve Bank can also do some lending to securities firms. Like many large financial institutions took money from the Fed in the financial crisis. And so we've seen that occur. They also can backstop and have backstopped money market mutual funds because there can be big issues. And once again, these are liquidity issues when things go awry, that they can back up money market mutual funds to where people can get their true cash, their money, back out of those types of funds. So they can do that as well. And then they do a lot in the overnight and repo markets, and basically allowing firms to borrow and lend cash and securities over the short term. And so this is something that the Fed can allow to happen as well. They do direct lending to banks, and they do that quite often as well. And then obviously they play many other major roles in our economy as well. And there's no way for me to cover them all, but I wanted to cover some of the big ones here today. And I said earlier that one of their major things they want to do is maximize employment. Well, obviously, that has a lot to do with making sure that economic growth is strong, making sure that companies have the money to employ individuals and are making money in order to employ individuals. So that goes a lot back into the interest rate levels and things like that. They can impact the amount of money that companies can get their hands on, which can impact the amount of individuals that are employed at any given time. And something new that the Fed actually did this past year is they made it to where they were buying up basically unlimited bonds. Like they were buying, not only good corporate investment grade bonds, and why would you want to buy those up anyway? How would that help anybody? But they were buying up a bunch of crappy corporate bonds to get them off the market, to not cause more damage to the system. And this was a very big step that the Fed took. And people were even talking about the Fed taking a step into purchasing stocks, and that would be a huge conflict and a huge issue in the market. But regardless of the intentions of the Fed, regardless of what you think that they are there trying to do, I think everybody can agree that it is good to have some governing body there for us, to have some groups of individuals that are trying to make sure that our economy can still grow. And there are a lot of detractors from the Fed, certain people that think the Fed is not necessary, the Fed overreaches on power, or that they are, driven too much by private corporations. And I don't discount any of those arguments. Some of them may hold some water. But at the same time, you cannot disagree with the fact that if there was no Federal Reserve Bank, if there was no central bank, that getting out of the Great Recession, getting out of the financial crisis would have taken a lot longer. Getting out of the coronavirus pandemic or having any type of financial growth on the backside of the coronavirus pandemic would be almost impossible. It would be almost impossible for the stock market to have risen like it has if there was no Fed action. It would be far less likely that the Treasury and other governing bodies took any action if the Fed did not decide to take action, because they are the governing body over financial markets and the financial system. And so we see their hands at work. And that's what I really wanted you to understand today, is that the Fed does impact your life. The Fed impacts the value of your portfolio. The Fed impacts, how much it's going to cost every month when you make your house payment. The Fed impacts, what the rate may be on a car that you financed. Even though I don't want you financing cars, if you did, the Fed is going to impact that. The Fed is going to impact how aggressively companies are trying to hire people into their businesses. The Fed is impacting so many things in our lives. And there's this saying that I've heard time and time again, and I found it to be correct. People say, don't fight the Fed. And what that means in financial markets is that if the Fed is keeping rates low, and they say they're going to keep rates low, and they're being accommodative in their policies, meaning that they are being business friendly and keeping rates low and, pushing money into the economy. And if they are doing those types of things, then don't bet against the market when those types of things are occurring. You should bet for the market. And there's a really interesting anecdote that I wanted to talk to you guys a little bit about here at the end, just so you can see the impact that the Fed can have. In 2018, I was working as an investment advisor, and something that we saw, and it had been a while since we had seen this, and so it was a bit of a shock to the market, was that the 10-year Treasury note, which is something that a lot of individuals in the financial system use as a benchmark to, okay, should I invest in stocks or should I move some of my allocation out of stocks? Because the higher that rate is, obviously you could be purchasing that and getting that risk-free rate of return, the risk-free rate as they call it, or you could be getting the return of the stock market. And we know that if rates are higher, that the returns on the stock market may not be as good. And there was this magic number of 3% that if rates were going to surpass 3%, that there was going to be an issue. And we saw some days where the stock market was just getting so beat up by the fact that rates were rising. And then when rates finally broke that 3% threshold, there was a little bit of pain being had in the markets. And it's just a way that I want to show you, and you can go back and look in 2018, this did occur. Into 2019, this is all prior to the coronavirus pandemic, when obviously rates fell to nearly zero. And now that 10-year rate is right around 1% as we are speaking now. But this is just showing you that the Fed can impact your life. The Fed can impact markets. And the Fed is never going out of their way to negatively impact markets, which is a good thing. But the question really arises that, is the Fed systematically devaluing our currency? Are we keeping rates too low for too long? Are we, not being, what we should be for companies? Is the bank not acting towards private companies how they should act? Are they being too buddy-buddy with private companies? And there's just all these different questions that can be asked. The big one that has been asked during the Trump administration is the Fed being pushed by Donald Trump, or is it actually an independent body like they say that they are? And so all of these different questions arise. But again, I just wanted you to be aware. I want you to be aware that the Fed is there. I want you to be aware of what the Fed is doing, and not just think that these things are random, not think that any of these things happen in a vacuum. Things happen for a reason, and there are individuals that are making decisions that impact several aspects of your life, not every aspect. And especially if you don't have any debt, the Fed can have far less of an impact on your life. But if you work for a company that can benefit from lower rates, or can benefit from more money being in the economy, and if not, you're more prone to being laid off or things of the like, then the Fed can impact your life in an indirect manner. So just be aware of the Fed, be aware of what they do, do some research, understand what the FOMC and Jerome Powell are doing, understand, when he comes and makes a statement, what those statements mean and how they're going to impact your life. And hopefully I can help you to do that as we move forward in this show. So hey, thanks for watching this episode. If you can, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below if you haven't done so already. If you're listening on Apple or Spotify podcasts, then make sure that you subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's a really good follow, especially if you like the things that I'm putting out in these long form episodes every single day. And if you need somebody to help you create a financial plan that would benefit you for the long term and would help you to build long-term financial strength, then I can help you to do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about something that is a bit related with what we talked about today, and that is inflation and the understanding of inflation, how inflation is impacting your life and can impact your life in the future. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.